Welcome to the recorded version of Paying for Caregiving, Client Strategies for Managing the Costs of In-Home Care from April 25th, 2018, brought to you by generous sponsorship from the National Reverse Mortgage Lenders Association. Jenny Werwa is the Director of Public Relations with the National Reverse Mortgage Lenders Association. Phil Bongiorno joined the HCAOA in January of 2014 as the new Executive Director. He serves as the Chief Staff Executive for the HCAOA, responsible for the association's overall operations. In his 20-year career in association management, Phil has represented a number of associations with a concentration on health and disability issues. Phil most recently served as a Director of Government Relations for the Society of Thoracic Surgeons. In his spare time, Phil is a marathon runner and has completed the Marine Corps Marathon 14 times. Nancy Avitabile is the owner of Urban Eldercare, an aging life care practice in Manhattan, and president of the Aging Life Care Association. Lorraine Geraci, is vice president of the training division at Finance of America Reverse, with more than 10 years' experience in the reverse mortgage industry and more than 20 years in training, coaching, and customer service. And with that, I would like to turn the presentation over to Jenny, Phil, Nancy, and Lorraine. Thanks for being here.
Thank you.
Thank you so much, Steve, and to the American Society on Aging for this opportunity to present today. As we all know, home care services can make a tremendous difference in the quality of life of older adults who are aging in place. We hear from our members that when they are meeting with seniors and families, the conversation often turns to long-term care supports and a discussion of options to help pay for the care in the home. Today's presentation, which is part of our third annual Reverse Mortgage Education Week, is for health and home care professionals and others who work with seniors who are aging in their own homes. By sharing information about the types of care available, the costs of those services, and payment options with you, we hope you will be able to provide more information and resources to your clients as they consider strategies for financing in-home care. Thank you, and now I'm very happy to hand the presentation over to Phil.
Thank you, Jenny. And good morning or good afternoon to everyone, wherever you are. And thanks to Steve and Jenny for inviting me to be part of this great list of panelists. As professionals who work with an older population, whether directly providing services in the home or coordinating care, referring care, or planning for care, it is critical that we are aware of all the different levels of care that are available to our clients and how they are delivered. Just as important to understanding care, it's important to understand the cost associated with care, whether provided by a professional or a family member, and the financing options and resources that are available. So today, we're hoping that after this webinar, you have some great takeaways and leave here more informed on this particular topic. My role today is to serve as a moderator primarily, but before you hear from the other panelists, I'm going to give just some brief remarks about the value of home care services and why it's important to figure out ways to fund for these important services. So a little bit about the Home Care Association of America. We actually started as the National Private Duty Association about 15 years ago. And we've grown to today where we are serving over our members are home care providers that provide in-home care services to support activities of daily living. And we serve currently nearly 400,000 seniors and individuals with disabilities. We employ about 500,000 caregivers, and we provide nearly 1 million hours of care per day. And we have about a $4.8 billion impact on the economy. Today I want to focus on a report that an industry report that we produced. It's probably now about 18 months old. It's called Caring for America's Seniors, The Value of Home Care. This report was not original research. It was a meta-analysis of a number of different research points that were available in the literature that we were able to put into this publication to talk about what home care means to different populations. And primarily, we looked at the benefits of home care. We looked at how home care benefits seniors, their families, and family caregivers, and we'll talk a lot about that today with a focus on family caregivers. The benefits to the American healthcare system and how there's cost savings built in to providing home care, and also just briefly about our impact on the economy and how we are a growing industry. So benefits to seniors, I think everyone would agree that having a caregiver in the home is beneficial to seniors just from a companionship level and providing that social interaction, but also more importantly is to help keep seniors healthy, to make sure that they are avoiding falls, they are keeping up with their medical regimen, and also other components of care that's provided in the home. The benefits to family, like I said earlier, I think there's a few more slides. We're going to really focus on family caregivers, particularly those that are still in the workforce, and how important this is. And when we talk about cost, we look at it at a macro level and look at really what is it costing the society for to have this provide home care services, and what home care can actually do to alleviate some of those costs on a macro level. We know that there are about 34 million Americans that are serving as family caregivers, and I think that statistic is probably a few years old. We've seen reports of that being higher. And we're going to talk a lot about, in a couple more slides here, about the impact of caregiving on family caregivers' health and why that's so important to address that. The benefits to the healthcare system, we have data that shows how we are providing savings to hospital costs, particularly when it comes to readmissions. So as individuals go home and receive home care from a hospital discharge, they're often, many times, not going back to the hospital as a result of home care and really creating savings in the healthcare system. We know that as the value-based system in CMS and other providers are looking at outcomes, we know that home care is a great cost-effective measure to help support and provide value to the healthcare system in this regard. And just benefits the economy. This is a brief comment just on the growing industry of home care and the work we do to serve families across the country. And just to give you a perspective, I want to just focus briefly on the workplace and why caregiving is becoming a workplace issue. We know through all the statistics that as the population ages, the workplace is experiencing huge changes. Employers are thinking about the impact on productivity, competitiveness, and social responsibility. And so there's a focus on how are corporations and other companies really supporting their employees that are serving as family caregivers. We know that the impact on productivity is real. I mentioned earlier the impact on health. Health suffers. Cost increase for companies that we know that there's higher health care costs on average for employees that are family caregivers. And we know that productivity of companies suffers. But to date, very few companies have recognized the problem, and few have really have any plans to address it. And we're working to educate companies in this regard. We know that employee caregivers struggle to balance work and care responsibilities, and thus resulting in an impact on productivity. We have estimates that over 34 million Americans, as we mentioned earlier, are serving as unpaid family caregivers, and we know that under these statistics here, employee caregivers only 56% report that to their supervisors that they're aware of their caregiving responsibilities. And this is really a really staggering statistic. The effect of senior caregiving could detract from the bottom line, the productivity impact. This data is probably just a couple years old, but this is probably conservative, that businesses are losing an estimated $34 billion per year in lost productivity from full-time working caregivers. And companies are already seeing a large economic impact from replacing mostly caregiving women who quit their jobs altogether at an estimated loss of $3.3 billion. And then the whole concept of occasional absenteeism is impacting the workplace, and you can see from this statistic how much that's having an impact on the workplace and productivity. So we are beginning to understand the need, and we know that family caregivers and those that are in the workforce are willing to put some of their own funds up to be able to get some kind of benefit either through an employee assistance program or other means. And so we see that there's an opportunity here to really address this need in the workplace. And one company, this is just a headline from, this is Deloitte, the consulting firm. This is probably now a year old. They now have a family paid leave policy that basically pays full family leave for individuals that need to take time off, and they will get paid while they are taking care of a family member, whether it's a senior or another loved one. And this is a great start for companies, we think. At the same time, we would love to see how companies could actually provide a benefit directly to provide home care services. One thing I wanted to talk about today is what the government is doing and some of the other institutions like the National Academy of Sciences. They put out a report called Families Caring for an Aging America. Many of you are probably familiar with it. This was put out probably right before the elections in 2016 to really address what are we doing in our society to support family caregivers. And this report had a number of findings to really look at and examine the effectiveness of programs and interventions designed to support family caregivers, and really concluded with a recommendation to develop a national strategy to support family caregivers. We know that millions of individuals, as we've established in the United States, are providing care, uncompensated care, to the tune of billions of dollars. And we know that oftentimes the caregiver is asked to do a number of tasks, primarily, or these are some of the tasks that some of our professional caregivers provide, but they're being asked as family caregivers to provide this. And it is a burden to many families to do that. And basically, the report concluded that we really need to look at the impact of caregiving on families, and if it's not ignored, that we really are compromising the well-being of our elders and their family members. And this is just a quote from Richard Schultz, the chair, that basically reiterates that conclusion in the summary of the report. So what has happened since that report has come out? Congress, although we see a lot of partisan bickering on a number of issues, we found that this is not a partisan issue. They passed the RAISE Act, the Recognize, Assist, Include, Support, and Engage Family Caregivers Act, to look at and direct the Department of Health and Human Services, HHS, to develop a family caregiving strategy. And I know that HHS is now, part of the legislation was to direct a development of a family caregiving advisory council on this issue, and they're moving forward in that process. And I'll just conclude to really say what we're doing as an organization in the home care industry. It's growing. You can see that across the country with the number of, to respond to the need for home care services. We've been supportive of groups like the Caregiving Action Network. We were part of a insert in the USA Today that was developed by Media Planet, and this was distributed in the weekend issue after Thanksgiving, and it really received a lot of pickup in the news, and to really look at how we're supporting our family caregivers. We also have an initiative called the Safe Home Care Initiative that educates families about the differences in care. All of HCAOA members are W-2 employees, and we follow certain standards, and we try to provide a distinction to families to understand the differences between independently contracted care and care provided by what we consider full-service companies like those that are members of the HCAOA. And finally, I just wanted to provide a slide for those that are looking for home care, or if you're interested in knowing more about the HCAOA, we have if you go to our website, www.hcaoa.org, you'll find, you can click on Find a Provider and be able to find home care services in your area. So now that we've talked a little bit about the value of home care and some of the costs associated on a macro level, I'd like to hand the presentation over to Nancy, who will outline the different ways to pay for it. Nancy?
Thank you. Thank you, Phil. And thank you, Steve. And Jenny, I'm very pleased to participate in the webinar. And I will review the various ways to pay for the home care. I want to acknowledge a few things that Phil had just stated. The new legislation, and also legislation that's happening in my state of New York, where the minimum wage for home care workers will increase to $15 an hour. We also have programs for family caregivers, and I feel as a whole we're seeing the value of caregiving being much more acknowledged, and certainly the difficulty of this work. So I'm going to review a few things in my presentation. I'm going to discuss private home care fairly briefly, review the different types of home care available in the home. I'm also going to review public options for financing care, private options for financing care, and I'm going to speak a bit about aging life care managers and how they can help families sort through all the various options. So private pay home care, yes, it is expensive. On a national average, and certainly here in New York, we're probably seeing figures close to $20 to $35 an hour. Certainly $35 being at the higher end, probably in the major metropolitan areas. So families have a number of different ways for obtaining home care. They can hire directly, which means they hire an individual. That individual works for their family. They're a caregiver. They may be addressing medical needs, personal care, but they're considered a household employee, and they work directly for that family. That family is required to cover that worker in disability insurance, workers' comp, and unemployment, as they are essentially a W-2 employee. It is all payroll, and I want to acknowledge Phil's statement on that. All home care workers are W-2 employees, in case anyone had a question about that. The other option for hiring home care is to use a licensed home health agency. The individuals who go into your home, who work for a licensed home health agency, are employees of that agency. That means the agency handles everything. They schedule the aides, they coordinate the aides, and the workers receive updates and trainings and in-service from that agency. Another type of agency is a companion agency. Once again, the workers in this agency work for the companion company. They are not direct hires by the family. The difference between a companion agency and a licensed home health agency is a companion is not permitted to provide personal care. And again, just stressing, federal labor laws apply, state labor laws also apply. And they might vary between states. So if you are considering a direct hire employee, please become aware of the payroll requirements, overtime requirements, and you can easily obtain this information by contacting a payroll service company such as Paychex. I'm going to say a brief mention on entitlements and benefits. Obviously, we can go into great depth on Medicare and Medicaid, but as far as home care, Medicare, as many of you know, is a federal universal entitlement. For individuals over 65, and some younger disabled individuals, it covers home care on a short-term episodic basis. So Medicare may cover a nurse, a home visiting nurse, some individual therapies like PT, occupational therapy, and a home care worker, a licensed home health aide, might be provided as well, depending on need. Medicare will cover the cost of these professionals in one's home, but on a very short-term basis. Typically provided in an acute care situation, but not a chronic care situation. Medicaid. Medicaid is generally a program for very low-income individuals. It combines state and federal resources, so it's state and federally funded. So that means it varies by state. In New York State, we have a very generous community Medicaid program, which has a 1-month look back for assets and can offer up to 24 hours in home care. Across the border in Connecticut, they do not have the same program, and certainly not in New Jersey. So it's important to understand if a family member may qualify for a state Medicaid program and what they would offer, what they'd be offered. And I'm going to also discuss veteran benefits. You can see here that the Veterans Affairs Administration offers a great deal of benefits. I'm going to discuss specifically the aid and attendance benefit. This is a benefit available to a veteran who has served 90 days of active duty with at least 1 day during a period of war. There may be benefits also for the surviving spouse. And medically, the veteran or the surviving spouse must be receiving assistance with activities of daily living, such as eating, bathing, dressing. That can include walking or ambulation, even bathroom needs like bathing and toileting. And they may even need nursing home or assisted living. There's an asset test as well, so they have to be under $80,000 in assets, and this excludes the home and vehicle, and also, as I just said, be paying out of pocket for some of their medical expenses. So there's some nice potential benefits here if one qualifies. The veteran is eligible for up to $1,794 per month, $1,794. A surviving spouse could be eligible for up to $1,153 per month. As a couple, the potential is $2,127 per month. So this is a really great program. And you can see that if two veterans are married to each other and meet the medical requirement, they may be eligible for even more. So, thinking about veterans' benefits, it may take as long as 4 to 6 months to receive payment from the VA. It could take even longer. The benefits do start retroactively from the first of the month following the date of application. It's a really easy assessment. So you can make one call and determine eligibility at no cost. A few more slides in, I've left some references for you. You can certainly contact the Veterans Service Association. I gave a name of another very reputable group. They can literally ascertain the eligibility with one call. I do want to caution anyone looking into this benefit to beware. There are a number of individuals out there and even companies that will encourage the application of these services, take a large dollar amount off the top, sometimes not come through with the benefits. I strongly suggest you work with the VA or an accredited service provider. And here's some resources for you. Okay, I'm going to talk about insurance. This is interesting. Permanent life insurance. So permanent life insurance, also known as whole life, universal life, individuals may borrow up to 90% of cash value. Now remember, every insurance policy is different. The insurance policy schedules are different. I'm speaking in broad terms. An individual may be able to take the full cash value of their life insurance. They might have to, though, forego the death benefit. So if there's a large cash value here of maybe $150,000, but you're going to lose a few million in death benefit, obviously that has to be weighed. Another option that's available is to take a loan off the cash value. So interest could apply here. And if you had not paid off the loan at the time of the death, of one's death, the insurance may still provide the death benefit less any remaining loan and interest from that loan. So, it could be a fairly good deal if you have a nice whole life insurance policy. One thing I want to mention, and this is relatively new, that in the last 2 years, permanent life insurance carriers have been issuing life insurance policies with long-term care riders, sometimes called accelerated death benefit riders. And if you qualify, and similar to long-term care insurance, which I'm going to speak about in the next slide, you have to show, again, the ADL, the activity of daily living deficits, which I had discussed in the VA slides, or cognitive impairment. You can use some of the death benefit or cash value towards long-term care while you're still alive. I'm also going to briefly review long-term care insurance. So this is a great option for those individuals who were lucky enough to purchase policies when they were younger. One thing to bear in mind is every policy is different. I must have reviewed hundreds of policies. You need to look at your policy schedule. They differ. They'll explain the day rate. They'll explain the elimination period. An elimination period is kind of like a deductible. It's the period of time when you start needing care to when the policy will kick in and reimburse that care. Some policies don't have an elimination period. Some have a 30 days, 60 days, 90 days. Again, it depends on the initial payments and the initial schedule to that insurance agreement. As with the VA benefits and these accelerated death benefit riders with long-term care insurance, one has to show ADL deficits, cognitive deficits, and in some cases, mental health issues, depending on the policy. One thing it's important to mention, some long-term care insurance plans permit the patient, the individual in need, to hire their own caregiver. So again, going back to that first slide, on a direct hire, they could actually hire their own caregiver without a licensed agency and get reimbursed for paying that individual. Many policies, however, and certainly some of the newer plans require that the person in need hire from a licensed home health agency. So just a quick discussion about home sharing. Obviously, home sharing and finding a roommate is a very good option for someone who is still very independent, cognitively intact, doesn't need a lot of care, but could use some companionship. And I've seen these sprout up all over the country. Obviously, there's high need for vetting, multiple interviews, finding that right match, finding individuals who can live together. But it certainly is something to look into as an option. So here we go. What is the plan? We have Medicaid, life insurance, VA, home sharing, long-term care, reverse mortgage. And, one thing I neglected to mention here is our private funds, obviously. If you have private funds and unlimited resources, you're certainly one of the lucky ones. If you don't, you're kind of juggling a lot of questions. And you may actually come up with a variety. You may use a little bit of Medicaid, you may have some long-term care insurance, but it's a very short-term policy. It runs out in a year. Then you do some Medicaid planning. There's all sorts of ways that to finance care and look at all these various options. So here's my plug and explanation of the Aging Life Care Professional. Who's better to help guide a family, at least initially, through this process, but an aging life care professional. So aging life care professionals, also known as geriatric care managers, are typically social workers, nurses, gerontologists, other healthcare professionals, sometimes occupational therapists. Specific knowledge and specialized training and experience working with older adults and the younger disabled. One thing to remember is aging life care professionals, especially those who are members of the Aging Life Care Association, follow a strict code of ethics and a strict standard of practice. The hourly fees vary from $100 an hour to $250 an hour, and that's also dependent on geographic region. One thing you can expect from an aging life care professional in general is that they would have some knowledge in core areas. So a geriatric care manager has knowledge of the legal arena, certainly as it relates to advance directives and developing trusts. They're not a lawyer. They're not going to make the trust for you, but they can certainly guide you in that direction. And that would be the same for financial, family dynamics, housing, healthcare, advocacy, local resources, and crisis intervention. These are, the 8 core areas that a care manager is suited to deal with. Typically, the care manager will conduct an assessment, develop a plan of care, coordinate services, and, if necessary, provide ongoing care and crisis intervention. The care manager monitors care, ensures needs are met. Families can receive ongoing communication. I personally have adult children across the country. I even have an adult daughter in Israel and one in Germany. So we're very much boots on the ground. We keep the families informed. We work with home care agencies. We support the home care workers as needed, and just basically make sure the coordination of care and the day-to-day is happening, as if that daughter were here to check in now and then. The aging life care manager is also in a very good position to make recommendations for the best style of home care for a family. I like to mention that direct hire home care using a registry or some people do word of mouth is not always the best option. Some individuals require home health aide level, someone who's very trained, and an agency who's going to support that plan of care. So when to refer to an aging life care professional? Certainly when concerns go beyond one's expertise and ability to help. I think we all get tapped out in our own personal resources. Sometimes it's more cost effective just to hire someone for an hour who can give you the information, and then, one can implement it from there. I often get calls when clients and families need information about community services. Another big reason for calls is the client has no support, or sometimes no local family, or sometimes no family at all. Clients keep falling through the cracks and they need an advocate. Often a social worker may call me because he or she has met a client in the ER for the third time in 2 months for really no medical reason. Building managers. I'm in New York City. We may get a call from a company, a realtor or a building manager saying, we've got a problem with a client. Can you come and help us do an assessment? The next slide. Client and family needs unbiased information. I really want to take a few minutes just to focus on this idea of unbiased and objective information. A geriatric care manager's first point of reference is the person in need. So even if they're hired by the family, if they're hired by a court, a lawyer, a wealth manager, they are, based on their standards of practice, required to work on behalf and make recommendations only to the on behalf of that older adult individual. So you can be sure the recommendations are unbiased and objective. And sometimes the families may not be comfortable with what the care manager may be recommending. But I would say, in general, it is usually always in the best interest of that person in need. Well, that kind of goes along with the next one. Family disagrees on next steps. Care managers are usually very good at working with families and family crisis. The caregiver feels overwhelmed and unable to move forward. We work with a lot of caregivers, a lot of male, female, quote-unquote spouses who are taking care of their husbands or wives. And, I see, certainly in regard to what Phil had stated, a big need for caregiver support. And client needs oversight of existing care. We do this really well. We'll do check-ins. We will report to families. We can text families across the country if we see something isn't going well, but we're also boots on the ground. We can call that home care provider. We can notify an agency that something's not quite right with the aid that's been placed. And of course, we will get called in occasionally when there's abuse, neglect, or some type of exploitation occurs. So if you are in need of an aging life care manager, you can go to aginglifecare.org, and we have an amazing search mechanism. Find an aging life care expert. You can find a care manager by zip code, by name, usually down to a 5-mile radius. Great. And finally, let's just take a quick look at where the money comes from. Individuals and their families pay 42% of long-term care costs from their own funds. And that's certainly my experience anecdotally. But this, I think, puts it very much into perspective when you see self-pay 42% of all long-term care costs. Okay, so now I thank you, and I'm going to turn over the presentation to Lorraine Geraci.
Well, before we do that, Nancy, I wanted to thank you for providing an overview of the options to pay for home care. And I know we're going to be taking questions, but would you say that there's one particular resource that is used above all the others? And how frequently do older adults utilize each of these options to manage the cost of care?
That's a really great question. I live in New York State. I have to tell you, I think Medicaid home care in this state is one of the most heavily utilized options because people use it when they certainly don't have the resources, or when they spend their own resources over many years paying for care. Next, I would say it's probably a combination of VA benefits and long-term care insurance.
Okay. So now we'll head over to Lorraine to present.
Thank you very much, Phil and Nancy. Really appreciate it. And Nancy, yes, as you mentioned, there are a variety of ways that older adults can obtain financial assistance for home care. And it's great that there are some choices that are available to them. However, in my experience and talking to a bunch of different people and training for a number of years, there are still a large number of people who are unaware of the power of home equity, such as a home equity conversion mortgage. A home equity conversion mortgage is also known as a reverse mortgage, and it's been assisting over 1 million older adult homeowners since 1987. Although the reverse mortgage has been around since the early 60s, the HECM program through HUD and FHA in the late 80s provided a regulatory oversight for the protected class of people. And it allowed our older adult homeowners 62 and above the opportunity to liquidate a portion of their equity without having personal liability of paying the loan back to the lender until they vacated the property. It also provides as an extended opportunity for homeowners to purchase a new home and get a HECM simultaneously, and again with no monthly payment. Over the years, there have been some misconceptions about the program, such as the lending institution owns the property or the borrower has to give up title, which is certainly not true. The home remains in the owner's name throughout the life of the loan. And what happens is, in my experience too, through teaching, the word reverse tends to showcase some misconceptions about the program. However, through education and utilization of it, it's proven not only to be a great retirement planning tool, but also a safe resource for assisting with health-related needs. It's a non-recourse loan, and what that means is that neither the homeowner nor their heirs are ever liable to pay back the loan personally. The loan is repaid when the borrowers no longer live at the residence through selling the property or leaving the home to their heirs through death. The FHA insurance will safeguard against the borrower ever owing more than the value of the property, even if the loan balance exceeds the available equity in the future. As many people are already aware, the number of older adults expected to continue in this upward trend, having over 92 million adults over the age of 65 in the years to come affects a variety of industries. Housing, financial, and healthcare. A high percentage of our older adults have no retirement savings, and one of the biggest fears for retirement is not health-related items, it's running out of money. There is over $6 trillion in home equity for adult homeowners over the age of 62. That's today. That's without this upward trend. And less than 2% of those homeowners have realized the opportunities associated with a HECM loan and what HECM loans can provide to them to assist in this growth. And again, 2060, the number of older adults, over 92 million people, will be over the age of 65. One of the many products available through a home equity conversion mortgage is called a line of credit. Depending on the amount of available equity that the homeowner can access, it depends on the age. The younger you are, the less money you're able to obtain out of your property. They may have an option for a line of credit. What's similar to a home equity loan is that there's a sideline of equity that's available to the homeowner to use when they need it. However, with a home equity conversion mortgage, that line of credit will compoundedly grow and become additional equity for them as time goes on and available to them. And unlike a home equity line of credit, it can never be frozen, withdrawn, nor is a monthly payment ever required back to the lender. In the example here that you see before you, we showcase here in the red line, this is a homeowner with a $495,000 property. If they were able to put their available equity, which is that line of credit amount of $215, in a line of credit, it could grow over $320,000 in a 20-year period. Many younger adults in their 60s are able to utilize home equity conversion mortgages to assist them for future health-related costs that will incur as they age. So it's a great option for people, especially our younger, older adults, to be able to prepare for the increased costs associated with home health care as they age. And it also helps with the caregivers, as Phil mentioned earlier, the financial burdens associated with caregiving and the homeowner's family members will certainly find an advantage by utilizing or liquidating home equity as opposed to trying to fund these home health care services on their own. In the National Housing Act in 1987 outlined the specifics of the program. So the government put forth a program to the lending institutions that home equity conversion mortgages or reverse mortgages were really there to meet the needs of elderly homeowners by reducing the effects of economic hardship caused by increasing costs of meeting health, housing, and sustenance needs at a time of reduced income through the use of their home equity into liquid assets. If you take a look at some of these statistics before you, it's really apparent that the ability for many older adults to pay for needed health care and housing needs is low. And health care costs will likely to consume almost a quarter of the income of our older adults as they move forward, which is certainly a staggering number. More than 7 in 10 older adult homeowners or boomers plan to downsize and subsidize on Social Security alone, which is obviously not enough to take care of the many needs associated with aging in place. Home equity conversion mortgage loans and conventional loans are similar yet different for adults 62 and over. HECMs do not require a monthly mortgage payment to the lender, and there are safeguards and protections as a non-recourse loan. Also, those that are able to use the line of credit growth feature is unlike any other product out there, and costs associated with the program are financed into the loan, so in most situations there are no out-of-pocket expenses for that consumer being able to utilize this program as they need it in the future. There are certain eligibility requirements associated with being able to participate in a home equity conversion mortgage. The homeowner has to be 62 or older. At least one of the owners do, and if there is a non-borrowing spouse that is under the age of 62, that couple can still participate in the program, and the non-borrowing spouse would be protected throughout the life of the program, even after the borrower passes. The borrower has to live in the property as their primary residence. It's not that they have to live there 12 months out of the year. However, it has to be their primary residence and where they file their taxes, etc. So the primary residence is a key indicator in being able to do a HECM loan. They also have to demonstrate the ability to maintain their property taxes and homeowners insurance. And the financial institutions are able to do what's called a financial assessment and determine that they have enough income and credit background to take care of those responsibilities even after the HECM loan is in place. If they don't, then the lender has the opportunity to put what's called a forced escrow, which we'll talk about later, to pay the taxes and insurance for the borrower. And lastly, the homeowners and their family members, if necessary, have to attend a counseling session with a HUD-approved counselor, and they have to obtain a certificate before entering into a HECM loan application with any lending institution. It's required before they can move forward with the program. As I mentioned earlier, there are some differences between a home equity conversion mortgage line of credit versus a HELOC or a home equity line of credit. They both provide the older adult home ownership. However, the line of credit portion can never be frozen or recast on the reverse side. And they also do not require a monthly payment being paid back to the lender. And another major factor is that that line of credit has a compounded growth rate regardless of what occurs in the marketplace with home value appreciation. So even if the home value were to depreciate over time, that line of credit growth will still continue for the homeowner and provide them with additional borrowing capacity as they age in place in that property. Here's an example of some aging concerns when it has to do with home health care. And obviously this is an example of somebody who wants to look into funding some health care because they're experiencing some problems. And often the adult children are also concerned about how the parents or them will be able to afford health care for their loved ones. In this example, we have an 80-year-old homeowner with a home value of $300,000. Based on some actuary tables and interest rate calculations, the approximate available proceeds would be almost about $155,000. So there's a lot of ways in which that homeowner can use that money. They can either get a monthly payment for lifetime. They can get a monthly payment secured to pay that home health care institution on what that is on a monthly basis, and that could last for a number of years. Or they can also put that money into a line of credit, as I showed you earlier, which they can use some to pay for health care, and the rest can be in a credit line for them to be able to access more funds later on. Half of my career in the industry, I've been lucky enough to assist hundreds of older adults, and many of them use this program to pay for home health care for their loved ones. Instead of having to go to a nursing facility, most people would rather be in their own homes. Home health care, as you know from what Nancy just mentioned, is very expensive. And in our example, we show here is an opportunity to be able to use home equity to purchase or pay for that kind of care. It's a resource that's available to our older adult homeowners without impacting their or their family's monthly income. There's a variety of ways that home equity conversion mortgages have made a difference in the lives of older adults. Financial security, estate planning for retirement that sustains the financial longevity, purchasing a new property and relocating to be closer to loved ones to help them as they age, enjoying passions in life, and paying for the rising costs of health care, as well as providing resources for home improvements to allow people to age in place comfortably. One of the things we review in many of our educational classes is the fact that it's a wonderful thing that we are all living longer. Through the amazing breakthroughs in the medical industry and technology, many people are living an average of 25 to 30 years post their retirement. However, many do not have the financial resources to sustain that longevity. Whether it's for health care or housing, the liquidatable opportunities of home equity can satisfy a variety of financial needs to allow our ever-growing older adults the opportunity to manage on these costs that they have to face. Here's some consumer protections that have to do with the home equity conversion program. Safeguards and consumer protections are really important in this protected class. And as I mentioned before, the mandatory HUD counseling needs to be completed before a borrower can apply for a HECM loan. The counseling sessions ensure that the borrower and any other interested parties are provided with specific information about the program and a confirmation that they understand. A financial assessment is performed to the borrower to determine if they can pay for their taxes and homeowners insurance even after the reverse mortgage is in place. If not, the lending institutions are required by the government to put some of the equity in a forced escrow to pay for that homeowner to prevent default. Again, as I mentioned, it's a non-recourse loan because of the FHA insurance. And what that means is, number one, if anything were to happen to the older adult homeowner, or actually happen to the lending institution, the borrower is protected. And if the loan balance has accrued interest over the amount of the value of the property, the difference is forgiven. Neither the borrower nor their heirs are ever personally liable for the loan. Also, the non-borrowing spouse, as I mentioned, is protected. In case the borrower passes, the non-borrowing spouse can remain in the property as long as they'd like to. They may not be able to utilize the resources from the loan, but they'll never be forced to leave the property. They can stay there as long as they want to. And also, lastly, there's no prepayment penalty. The loan can be repaid back at any time, whether in pieces or in full, however the borrower sees fit. So as you can see, untapped home equity can provide a variety of financial options for older adults. When it comes to home health care, the importance to provide options and choices to afford older adults with the care that they deserve is essential. And it's important that people are educated on how HECMs can help with health and longevity. So thank you for your time. Steve?
Actually, Lorraine, this is great information because as we heard from Nancy, Most people are self-funding a significant portion of their home care cost. If a client is interested in a reverse mortgage, where should they look for a lender?
Well, that's great that you ask, and the next slide will show you. On reversemortgage.org is a guide for reverse mortgages, and anybody can go in here and find an approved lender that would be able to provide them with information. Some of our lenders are members of the National Reverse Mortgage Lenders Association, thereby abide by the rules and ethics and all the regulatory information that they seek fit through them. So here's where I would send people to go look.
Terrific. So thank you very much, and I'm going to hand the presentation back to Steve for our Q&A. Steve?
Thanks, Phil.
All right, great. Thanks, everyone. Thanks, Lorraine, Nancy, Phil, and Jenny. And everyone, it is time for the Q&A, so send in those questions right now. And presenters, let's jump right into it here. First question here, are the proceeds from a HECM protected from an LTC event? If they are not, is there a look-back period that they would have to be taken outside of to be protected?
Great question. The answer to that is yes. The look-back period is only reference to whether or not the borrower has their home in a life estate deed. And if they can put the life estate deed if they want to and get a HECM. However, there has to be a 5-year look-back period for that. However, in general, the proceeds are not subject to that at all.
Okay, great. Next question. What happens in a HECM situation if the estate doesn't have enough money to pay off the loan?
That's a great question. Also, the FHA insurance would kick in. So the homeowners would only have to pay, or the heirs would only have to pay whatever the home value is worth at the time that the loan needs to be satisfied. In addition, the family members or the children of the homeowner, if they passed away, the children are eligible to purchase that property for 95% of the value, and the difference is forgiven and satisfied through the FHA insurance program.
Okay, thank you. Next question. If one spouse dies and they had a reverse mortgage, does the surviving spouse get to remain in the home?
Yes, they do.
Great. Okay, Lorraine, this question is for you. What happens to the loan if the borrower needs to move into a long-term care setting permanently? Some people cannot afford to cover 24/7 care in their own homes with their resources.
Yes, that's correct. So the borrower has to be, like I mentioned before, it has to be their primary residence. They have to be if they're out of the property for a consecutive 12 months or longer, the reverse mortgage becomes due and payable because they're no longer considered a primary resident. And thereby it becomes due and they have to satisfy it as if they vacated the property by sale or through passing on to heirs. So that's really the key indicator, is that 12-month time period.
Okay. Next question. How do I go about finding an aging life care professional?
Oh, hello. Hi. On this slide, you'll see you can go to aginglifecareassociation.org. On that home page, in the upper right corner of the home page, you will see a large box to click on that says Find an Aging Life Care Manager. You can click on it, and it will take you right into a small questionnaire, which will ask your zip code, state, and permit you to choose the type of aging life care professional you'd like to hire, advanced certified member, a professional member, and you can also pick the radius if you want someone who lives in your neighborhood or maybe someone who's 30 miles away. And then you'll get, it will filter out a number of options. You can see a list of individuals in your area. Hopefully most of them have a photograph and a bio and a connection to their website or certainly their contact information.
Okay, great. Well, we have reached the end of our hour here, and unfortunately we are out of time. But Jenny, Phil, Nancy, and Lorraine, I want to thank you for joining us today and for a great presentation. Thank you so much.
Thank you
very much.
Thank you very much.
Thank you.